All right, let's just dive right in. Welcome to this explainer. Today, we're taking on some of the most complex financial tools out there, portfolios and derivatives, but we're not going to do it by staring at dry spreadsheets or chaotic Wall Street trading floors. Instead, the source material actually guides us to a quiet terrace. It's arranged almost like a metaphorical trading floor, alert, layered, and full of invisible movement. We're following two characters here, Meera and Aarav, and they view finance not just as some ruthless numbers game, but as an art form, the art of balance and breath. So let's see how they pull this off. Our journey starts with Meera arriving on this terrace. She sets down the small brass compass and the needle is just trembling slightly. Engraved on the base is a single word, santalan, which means balance. She's got a packet of dried kiwi slices, a printout of an investment sheet, and she asks this really profound, grounding question. What do we hold? What do we hedge? And how do we stay steady? It's a great question, right? It perfectly sets the tone for everything we're going to unpack today. It's all about finding stability in a world that literally never stops moving. Now, what's really striking here is the contrast they set up. Usually when we talk about portfolios, we just define them as baskets of assets, right? Strict mathematical allocations meant to maximize returns. But Meera and Aarav totally challenge that. They reframe portfolios as beliefs and attitudes. Because picking and managing investments, it isn't just about raw returns. At its core, it's about human resilience. It's how we actually hold our risks and our rhythms together. So how do we actually measure that risk? Well, let's look at the Capital Asset Pricing Model, or KPM for short. The formula tells us that expected return equals the risk-free rate plus the product of beta and the market premium. Okay, sounds like pure textbook math, I know. But our source material brilliantly reframes this academic model. It's not just an equation to solve. It's a tool for foresight. Think of it as a way to map the territory that lies ahead. To get a sense of what that mapping actually looks like in the real world, let's look at three practical examples. First, a textile firm used CAPM to figure out if a new dyeing unit would outperform the market. Sure, the beta, the risk, was high, but so was the potential. It gave them that crucial foresight. Then, a cooperative evaluated its equity holdings, adjusting for inflation and volatility. For them, CAPM was literally a mapping exercise. And finally, a bakery used it to evaluate investments in local food startups, which goes to show CAPM isn't just for Wall Street, it works for croissants too. It really helped them find their specific financial rhythm. Building on that idea of foresight, we get to our next concept, Arbitrage Pricing Theory, or APT. Now, CAPM is incredibly useful, but it pretty much relies on a single story, which is market risk. APT takes a much wider view. It evaluates investments by looking at multiple macroeconomic factors all at once, things like interest rates, inflation, and overall GDP growth. If CAPM is a solo instrument, Meera describes APT as a full financial symphony. And you can really see how versatile APT is across completely different sectors. For instance, a publishing house applied APT to its diversified portfolio of stocks, bonds, and real estate, tuning into that symphony of factors. A school trust used it to evaluate an endowment fund, but they were weighing shifting demographics against new tech adoption, proving that a good portfolio isn't just protected, it's prepared. And our bakery from earlier? They actually layered APT right on top of CAPM for their startup investments, just to give their strategies some real depth. Okay, so the main takeaway here is that portfolios lay our groundwork. But what happens when the ground itself starts to move? That brings us to the sometimes intimidating world of derivatives. Now, traditionally, derivatives are strictly defined as financial instruments whose value is derived from underlying assets, like stocks or commodities. But Aarav and Meera see them quite differently. They view derivatives as temperaments. They see them as human instincts that prepare us for inevitable market swings. Let's break down the actual mechanics of one specific type of derivative, options. A call option gives you the right, but crucially not the obligation, to buy an asset at a set price. A put option, on the other hand, gives you the right to sell. And what you should really take away from this is that options aren't about guaranteeing certainty, and they certainly aren't about reacting in panic. Fundamentally, they are about building a cushion so you are prepared for literally whatever the market throws your way. Let's ground this in some reality. Think back to our textile firm. Cotton prices can swing wildly, right? So they bought call options to hedge against those sudden price swings. They didn't know exactly what the market would do, but it gave them a cushion. Meanwhile, our cooperative used put options to protect themselves just in case the price of milk suddenly plummeted. As Meera notes, buying these wasn't an act of panic, it was just pure, smart preparedness. Now, to understand how these actually pay out, we have to look at option payoffs, and it's really a simple three-step process. First, you identify your set strike price. Second, assess the current market price. And third, you account for the premium that you actually paid for the option. The bakery we talked about used payoff diagrams to visually map out whether they should hedge the price of flour. Seeing the risk and reward visually like that turns the math into a tangible story. As Meera puts it, these payoffs aren't just dry outcomes. They are echoes and narratives of our decisions. Of course, figuring out the exact premium, the actual price of the option, requires some pretty complex pricing models, things like the Black-Scholes or binomial models. Our publishing house, for example, used the binomial model to price options on paper futures. But Aarav makes a fantastic point about this. Running these pricing models isn't just about cold prediction. It's about calculating possibility. It's really about finding harmony in your overall financial planning. Moving beyond options, we run into forwards and futures, and there's a really clear distinction between the two. Forwards are private, completely customizable contracts between two parties. Futures, however, are standardized contracts that are traded on an exchange. But if we strip away all the financial jargon, what are they really? They're simply methods of stability. They aren't tools for blind speculation or gambling. They are solid ways for a business to firmly ground itself when times get unpredictable. Here are 3 quick examples of what that grounding looks like in action. The cooperative used private forward contracts to lock in milk prices directly with their retailers. Boom, direct stability. The textile firm used standardized futures to hedge against currency risk on their international exports, which takes the gamble right out of it. And the school trust? They used currency futures to make sure the value of their overseas donations didn't randomly fluctuate. It's not just clever finance, it's basically an act of faith in their future operations. Okay, let's shift our gaze inward for a second, away from external market risks and down to the daily operations of a business. Let's talk about working capital. It's calculated simply as current assets minus current liabilities. Basically, you're balancing your inventory, your receivables, and your payables. I know, it sounds a bit mundane, but Meera beautifully describes working capital as the literal breath and lifeblood of a business. It's not just a metric of liquidity, it's the life of the enterprise. And managing that breath requires a steady rhythm. When cash was getting a bit tight, the bakery offered early payment discounts, which was an act of careful pacing, not panic. The cooperative actively managed its cash conversion cycles for procuring milk, ensuring they always had fluidity. And the school staggered its fee collections and vendor payments throughout the year. None of this was just arithmetic. It was an exercise in deep, daily financial mindfulness. So what happens when we scale this rhythm across borders? International finance is almost always viewed through this aggressive lens of global expansion. You're dealing with cross-border exchange rates, complex regulations, huge political risks. But the source material asks us to look at this from a completely different angle. To successfully manage money across cultures and borders, what you really need is deep empathy and trust. Just look at how global finance plays out when empathy and trust are actually prioritized. The textile firm used multi-currency invoicing for its European exports, specifically to find harmony with its buyers. The cooperative entered into currency swaps to manage their exposure to the Japanese yen when they were buying equipment, and that is a transaction built entirely on mutual trust. The school used dual accounts and really rigorous audits for their foreign grants. That isn't just about jumping through hoops to get funds, it's about deep, genuine accountability to their international partners. A massive part of building this international trust happens in the foreign exchange, or forex market. This is the space where currencies are traded via spot, forward, and swap markets. But again, Aarav and Meera remind us to look deeper. Forex is so much more than just conversion rates ticking away on a computer screen. It represents a living, breathing, global rhythm that connects us all. Mastering that global rhythm requires some very intentional strategies. For instance, our bakery used immediate spot rates for small, everyday chocolate imports, but they made sure to lock in forward contracts for their major bulk orders. The publishing house utilized Forex platforms to perfectly time royalty payments to foreign authors, which is really an act of care. And the cooperative tracked macro Forex trends to precisely tune exactly when they bought international equipment. It's all about planning, care, and tuning. And so, we bring it all back to the terrace. The dried kiwi slices are pretty much gone at this point. The brass compass is sitting perfectly still. Meera whispers that portfolios are not just baskets, they're beliefs. Aarav replies that derivatives are not just instruments, they're instincts.
Together, they've managed to take these incredibly complex financial tools and synthesize them into a cohesive feeling of balance, right there on a quiet, layered terrace full of breath.
As we wrap up this explainer, I want to invite you into their reflection for a moment. Take a look at your own life, your own business, or your personal investments, and ask yourself this really fundamental question. What do I hold and why? Are your allocations truly reflecting your actual beliefs and goals? Think about the uncertainties that are inevitably sitting on your path. How do you hedge your hopes? What kind of cushions are you building right now, whether they're financial, professional, or personal, to make sure you are prepared rather than panicked when the unexpected inevitably happens? Consider your daily operations, your own personal working capital, your energy. What breath do you need to stay balanced? Are you pacing yourself? Are you practicing the kind of mindfulness required to keep the fluidity of your day-to-day life moving smoothly without burning out? And finally, as you look out at our deeply interconnected world, ask yourself, what rhythms do I honor across borders? Whether that's a literal global transaction or just taking the time to understand a different cultural perspective, how do you cultivate trust and empathy? As Meera and Aarav ring their brass bell to mark the rhythm of their day, it leaves us with this final thought. The real question isn't just how you'll balance your portfolio tomorrow, it's whether you're brave enough to change your underlying beliefs to actually do it. Something to think about. Until next time, keep finding your balance.